Something happened in the silver market 60 minutes ago that Wall Street is desperately trying to keep quiet. And if you're holding physical silver, trading futures, or watching the global monetary system right now, the next 11 days will decide everything. I'm Marcus Caldwell, independent market analyst. What I'm about to show you is not speculation. It's cold, hard, verified data that three major institutions are tracking right now. Let me give you the number that made me cancel my morning meetings. Silver, $77 per ounce. 1 year ago, $32. 1 month ago, $121. This morning, $77. Before you think this is another doom and gloom crash video, let me reframe this completely. Even after the most violent one-day crash in silver's recorded history, a 37% wipeout on January 30th that took silver from 121 down to the mid-70s, silver is still up 140% year over year. A commodity that went up 277% in 12 months, suffered the biggest single-day crash in history, and is still up 140%. That is not a crashing market. That is a market in the middle of something much larger. And this morning's price action, silver hitting fresh February 2026 lows at 77 globally. That's not happening in a vacuum. It's happening with three specific catalysts converging at the exact same time. Before I walk you through each catalyst, if this institutional level market intelligence is valuable to you, hit that subscribe button and turn on notifications. This channel exists to give you the analysis that mainstream financial media won't touch until it's too late. Your subscription directly supports independent research. Now let's examine what the smart money is positioning for right now. The first catalyst is what I call the Chinese liquidity blackout. Today marks the start of Chinese New Year. Chinese markets just closed and won't reopen until February 24th. That's 8 full trading days without the world's largest silver consumer, largest producer, and largest speculative market completely offline. When Chinese buyers are active, they absorb selling pressure. Deep pockets, high volume, they provide the cushion that keeps violent price swings in check. When China goes dark, liquidity evaporates. Any selling pressure that would normally get absorbed instead moves price fast. We saw this exact setup before the January 30th crash. We are currently in the same window. Thin liquidity, high volatility, maximum uncertainty. The second catalyst is the COMEX inventory crisis that nobody is connecting the dots on. COMEX is required to hold physical silver that can be delivered against futures contracts. This is called registered inventory. As of February 13th, registered COMEX silver sits at 98 million ounces. In 2021, registered silver on COMEX peaked at 152 million ounces. We are down over 50% from that peak. But here's where the mathematics become genuinely alarming. March delivery contracts beginning February 27th, just 11 days from now, represent potential claims on over 400 million ounces of silver. COMEX has 98 million ounces available. The math does not work. There is not enough registered silver to satisfy even 25% of March delivery claims. Just last week, in a single day, 3.2 million ounces were withdrawn from registered stocks. The drain is accelerating toward the most critical delivery date of the year. The third catalyst is the Shanghai premium, a $10 price gap that simply should not exist. Right now, while Western futures markets price silver at $77 to $78, physical silver in Shanghai trades at a $10 premium over Western spot. That's $87 to $88 for the exact same metal. In a functioning market, that gap closes through arbitrage. The fact that this premium persists tells you one of two things. Either Western paper markets are underpricing real physical metal, or Eastern buyers are panic buying ahead of a supply constraint they already see coming. Given that COMEX inventories are draining, Chinese markets just closed for 8 days, and March delivery is 11 days away. I know which explanation the data supports. Paper markets are mispricing physical reality. And when paper price catches up to physical price, it doesn't happen gradually. It happens violently. Now let me tell you what shifted in the last 60 minutes. At approximately 6 a.m. India Standard Time this morning, Asian markets resumed trading after the weekend. Silver opened with immediate selling pressure. The support level that held for weeks broke clean. No bounce, no defense, just straight through. The $78 psychological level was tested and broke during Asian trading hours. Volume spiked in the first 30 minutes. This was not retail volume. These were large, coordinated institutional orders. This is positioning, not panic. But here's what has my attention. The physical market hasn't followed. Dealers in India report buying interest has evaporated, but so has selling. The retail market is frozen. Nobody is buying at these prices, but nobody is panic selling either. This move is happening entirely in the futures market, the paper market, the market where leverage lives. Futures markets can be moved with leverage. Physical markets cannot. When those two realities collide, one of them has to give. Based on everything I'm tracking, there are three possible scenarios between now and February 27th. Scenario 1 is a capitulation sell-off, about 30% probability. Shorts use thin Chinese New Year liquidity to press their advantage hard. They drive silver down to $70 to $72, triggering stop losses and margin calls. The key level is $76. If that breaks with volume, we're heading to 72. Why the lowest probability? Because COMEX inventories are too low. Industrial demand hasn't weakened. You can push paper price down, but you cannot conjure physical silver out of nowhere. Scenario 2 is consolidation in the 70s, about 45% probability. Silver trades sideways between $74 and $82 through Chinese New Year. The market waits for China to reopen February 24th. Volume is thin, volatility is high, but no directional breakout. Then, as February 27th approaches, we get clarity. This is the everyone holds their breath scenario. Scenario 3 is a March delivery squeeze, about 25% probability. As first notice day on February 27 approaches, holders of March futures must decide: roll forward, cash settle, or stand for delivery. If even 25% of March contracts stand for delivery, that's 100 million ounces. COMEX has 98 million ounces registered. COMEX either forces shorts to buy physical metal in the open market, or they change the rules. And if they change the rules, watch what happens to the Shanghai premium. Watch what happens to global confidence in Western paper markets. Watch what happens when buyers realize paper promises are not the same as real metal. This is the 25% scenario with a 100% chance of being historic if it happens. Let me explain why February 27th matters. First notice day is when holders of March silver futures can officially demand physical delivery from COMEX. In normal markets, 90 to 95% of contracts never result in delivery. People settle in cash or roll forward. But these aren't normal markets. The London Metal Exchange did this with nickel in 2022. They halted trading, canceled executed trades, and forced cash settlement to protect shorts. Here's the difference this time. After the January 30th crash, where Treasury Secretary Scott Bessent publicly blamed Chinese speculators, global confidence in Western paper markets is already damaged. If COMEX changes the rules in March to protect shorts, it won't just be a market event. It will be a credibility event. It will confirm what Eastern buyers already suspect, that Western paper markets are not backed by real metal. The Shanghai premium won't be $10 over spot. It will be $50, $100, however much it takes to find physical silver that actually exists. Two markets, one for real metal, one for promises. Let me give you my exact watch list for the next 72 hours. Signal 1. Volume and momentum in Asian trading tonight. Watch the first 4 hours Monday night into Tuesday morning U.S. time. Sustained buying pressure above $78 tells us physical buyers are stepping in. That's a bullish signal. Continued selling with volume means shorts are pressing while China is offline. Signal 2, the Shanghai premium on Tuesday. If the Hong Kong physical premium widens from $10 to $12, then $15, then $20, that's your early warning that Eastern physical demand is outstripping Western paper supply. Signal 3, the COMEX daily inventory report. If we see another large withdrawal over 2 million ounces, the drain is accelerating into March delivery. If registered stocks drop below 95 million ounces this week, March delivery becomes a genuine crisis. Signal 4, options positioning at the $80 and $85 strikes. There is massive call open interest at those strikes expiring this month. As silver approaches $80, market makers must hedge by buying futures. That creates mechanical buying pressure, a gamma squeeze. Watch how price behaves approaching $80. Let me zoom out because the silver story isn't really about silver. It's about the monetary system and the cracks starting to show. In 1971, Nixon closed the gold window. The dollar was no longer backed by physical gold. It was backed by trust. For 50 years, that trust held. But look at what's happening now, all at once. Central banks buying gold at record pace, over 1,000 tons annually. BRICS nations building alternative trade settlement systems to reduce dollar dependence. Countries like Poland citing national security as the reason they need to hold gold. And in Shanghai, physical silver trading at 13% premium over Western paper markets. These are symptoms of a system slowly, quietly losing credibility. Silver and gold are the thermometers measuring that loss of trust. When silver hit $121 in January, the market screamed something was broken. When it crashed 37% on January 30th, the system pushed back, trying to restore the illusion of control. But the underlying fundamentals didn't change. The debt is still growing, the money supply still expanding, the supply deficit in physical silver still real, and the world is still methodically moving away from dollar dependence. What happened this morning is just the next chapter. Let me be clear about what I am and am not saying. I am not telling you to buy or sell silver. If you hold physical silver, understand what you're seeing. The volatility is in futures, in paper contracts. Physical silver is not going to zero. Industrial demand is real. The supply deficit is real. If you trade futures or options, understand the risk clearly. This is not an environment for leverage. Thin liquidity, China offline, March delivery approaching. Overnight gaps can liquidate positions before you wake up. If you're considering silver for the first time, understand what you're buying. Physical premiums over spot are running 8 to 12% right now. Dealers are charging $85 to $87 for metal that paper markets price at $77. That spread exists because physical is tight. Don't wait for paper price to drop to $60 expecting to buy physical at that price. It may simply not be available. Something shifted this morning. Whether it was final capitulation before a bottom, the setup for the next leg down, or the springboard for a March delivery squeeze that nobody in mainstream media is covering yet, we'll know soon. The next 72 hours, the next 11 days, February 27th. Those dates will tell us a lot. The people paying attention right now, understanding the inventory math, watching the Shanghai premium, tracking the February 27th delivery clock, those people are positioned to make sense of whatever comes next. The people dismissing this, trusting that paper prices reflect physical reality, waiting for mainstream media to tell them something's wrong, by the time that happens, the move is finished. You're hearing this now. That's worth something. If this intelligence was valuable, drop Silver Watch in the comments. I read every single one. And if you know someone who holds silver, trades commodities, or has been watching what's happening to the dollar, share this with them. Not because I need the views, because they need to know. I'll see you in the next update.